This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Markets kick off August on a cautious note. Investors assess more lackluster data from China while the RBA keeps the door open to future hikes. Mixed earnings news. We've got a roundup of the latest results from big oil to autos and the world's largest distiller. And there's still more blockbuster earnings to come before the week is out. Plus, UK house prices are falling at the fastest pace since 2009. Details on that data amid the Bank of England's fight against inflation. Welcome to Bloomberg Surveillance. This is the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, happy August, the start to a new month, which seasonally usually isn't good for equities, but we are off the back of 5 consecutive months of gains for American equity.
Yeah, if the bulls were waiting for some sort of break in their winning streak, they might just have one this morning, Dani. Is that the start of that seasonal trend, though? That's still to be determined. Futures, though, they are in the red, and you're seeing them in the red by kind of a heavy margin, down about 0.3% earlier in the session by a bigger margin as well. So this is going to be a story of just how much momentum they can really keep as we get more of those earnings coming through. But I would argue a lot of this is sentiment as well. Sentiment coming out of Asia. We did have some not so great Chinese data as well, which really made the Chinese markets the underperformer of the region. So perhaps some of that seeping in through to the whole growth story of the entire world. The 10-year yield gets interesting, though, because technicals are playing a factor in the bond market. But I'd argue in the stock market as well. Round numbers are your friend, it seems like, when you're trying to roadmap where the markets are going next. For the futures, 4,600 seems to be that level. For the 10-year yield, it's 4%. So you're looking at 397 right now on that note, higher by just about 1 basis point. So no major movement just yet, but that could again change as we get more of those earnings, get closer and closer to those opening bells. But of course, overnight, the big story is going to be coming out of Australia, who are seeing the Reserve Bank of Australia essentially pause for a second time in a row. They're saying, look, a hike still might happen down the road as we talk about inflation. But if you look at what the analysts and economists are saying, they're saying, look, they've done it. They've won the battle of inflation. So the RBA is really effectively kind of front running what a lot of people expected the Federal Reserve to do. And that, of course, is creating some weakness there as well. You are also looking at, again, the Asia Pacific index, on the other hand, rising simply because of that inverse kind of correlation. Essentially, the weakness you are seeing in the rates market, perhaps giving a little bit of a tailwind there. And of course, we also have to keep in mind that they are also dealing, Dani, with that weaker Chinese data as well. A lot of exposure for the Australian economy there.
Yeah, the days of low volatility in FX markets, they really are far behind us. In Europe, we are seeing some of the pain filter through from the weak China data. One of the worst performing sectors is basic materials. That's where you see that will filter through. But what's really weighing down on a European index that on a headline basis is down 0.4% are autos. The worst performing sector, BMW, out with a trade update, a warning that supply chains are becoming more expensive for them. That's weighing on the sector as a whole. When it comes to FX this morning in Europe, it's all about that strong dollar. That seems to be the dominating theme. Euro versus the dollar weaker by about 0.2%. We're still under 110. We had some European data on manufacturing PMIs for Spain, Italy, and France, all of them still in contraction. We just also had some unemployment data that stays unchanged at 6.4%. And meanwhile, sterling, Kriti, we're going to dive into the housing story. I know you got this one, but just pointing out that we are only slightly weaker at 128 on cable.
Certainly something to keep in mind, again, as we dive into the data. Dani, let's go right there. UK housing prices falling at the fastest pace since 2009. A jump in borrowing costs and the threat of worse to come is holding back demand from potential buyers. That's according to one of the UK's largest mortgage lenders. Joining us now is Bloomberg's Katie Linsell. Katie, how serious are a problem when it comes to those rising mortgage rates? We know the UK housing market functions a little bit differently than the way it does here in the States, but walk us through the ramifications.
Yes, I think really the focus now in terms of the UK's big fight against inflation is focusing on mortgages. Even if we look at the UK consumer having more strength in certain other areas, as long as mortgage rates are increasing, it's really going to be a burden on the consumer. And we've seen since late 2021 about 13 interest rate increases from the Bank of England. That's a sort of a continuous pressure on the consumer. And as we're seeing today, this really meaningful data in terms of house prices falling by the most since the financial crisis, it's really becoming a real burden on consumers. We also know that there is more pain to come. We've seen from Bloomberg Economics figures saying that they think house prices could have another 5.5% to fall. And the Bank of England is meeting on Thursday, and we could see another interest rate increase come through. So really the focus is shifting onto mortgages, and whether there can be any relief for consumers in the months or maybe year to come, it's still to be seen.
Is it coming in the form, that relief of shop prices, Katie, which, as you wrote about this morning, finally dropping for the first time in 2 years?
Yeah, that's an area where at least we can be a little bit more optimistic. So we're seeing shop prices across the board actually fell in July. It was a very small decline. It was only 0.1% of a decline. But that's still quite meaningful for consumers, because it's great when we can actually talk about prices falling rather than simply inflation easing. The key area where people are really looking there is food inflation. That's the product that we all need to buy all the time. And there we've seen a decrease for 3 months in a row. We've seen inflation slowing. So that's really, really positive. And we're seeing food price inflation at the lowest level since December. Having said that, there are more burdens ahead in food supply chains, and we can expect global commodities to potentially increase. The focus there is on grain shipments from Ukraine, and how Russia pulling out of a recent agreement over grain shipments means there's going to be more pressure there, more pressure on rice exports also from India. So I'm afraid on food price inflation, we're not out of the woods, but there is at least some cause to be optimistic there.
Yeah, and perhaps something that the Bank of England comments on later this week as well. Katie Linsell, thank you as always. And of course, as we talk about the Bank of England and that higher rate dynamic to tackle the inflation dynamics Katie was just talking about, they're actually helping the banks. In fact, higher global interest rates boosted HSBC's profits. The bank beat analyst estimates for the second quarter with a bullish outlook for the year. CEO Noel Quinn spoke on Bloomberg earlier.
Those results are a function of good revenue growth across the globe. All of our global businesses had strong revenue growth. All of the product lines within those businesses, strong revenue growth.
Bloomberg Finance editor Tom Metcalf joins us now. Tom, a really good set of results coming from HSBC. What drove them?
Yeah, well, look, it's really those rise in interest rates. We saw it's a net interest income story, really. And obviously, you just heard Noel Quinn talking about their strategy. But that really sort of, like for all banks, does depend on those interest rate rises. But yeah, no, pretty positive across the board, and obviously the buyback getting a lot of attention.
What about when you break it down by any line items? Any of those catch your eye, Tom?
Well, I was, scouring through it, seeing if there was sort of anything other than the sort of the good news story painted. I think largely, there's no great surprises in there. If you dig in a bit, they've got about $900 million of estimated credit losses, effectively charges against future loan losses. But, that seems eminently reasonable. I'd probably point out the sort of Chinese real estate as probably the only area where perhaps there's some sort of hidden risks there.
All right, Tom, thank you very much for that update. That's Tom Metcalf from our finance team. Let's turn to oil now. BP raised its dividend by 10% and said it would buy back another $1.5 billion worth of shares, even as its second quarter profits fell by more than expected. I spoke to CEO Bernard Looney earlier today.
It's been a good quarter, and it's that performance and that outlook that has given the board the confidence to announce the $1.5 billion buyback this morning. And as you said, importantly, also increased the dividend by 10%. And that dividend increase of 10% is in part due to the fact that we've reduced our share count by 9% over the last 4 quarters. So we can essentially keep the dividend amount the same while increasing the dividend per share.
Let's dig more into these results. James Herron, Bloomberg European oil editor, joins us now. James, in speaking to Bernard Looney, they're really exuding this confidence and saying that's why we were able to give this shareholder return. But at the same time, I mean, their profits reflect what's happening in oil and gas at the moment. How do you weigh up those two for BP?
Well, I think that obviously there's been a big drop compared to the records last year, but the outlook, as the CEO said today, is actually quite good, especially for oil. He said demand is incredibly resilient, and of course OPEC is cutting production, and he sees stronger profits going into the coming months.
James, that really differs and diverges from what we're hearing from the likes of Chevron and Exxon here stateside, where they're actually perhaps pulling back on rewarding some of their shareholders. Why is BP so confident this is going to work in their favor in the long term, looking at those dividends and buybacks?
Well, I think that partly reflects the difference in position because, of course, BP was one of the companies that really cut its dividends during the pandemic. And so they're trying to persuade investors again that, yes, we can be a reliable source of cash returns. Even if there are the peaks and troughs of the oil market, you can rely on us to keep generating the yield. They're trying to win back a reputation that they used to have before the big dividend cuts in 2020.
James, thank you so much for that. That's James Herron off the back of those earnings, as you can see, moving shares higher by about 3%. All right, coming up, more earnings in focus. We're going to dig into Man Group's results. The world's largest listed hedge fund saw a pre-tax profit drop in the first half, even as assets under management surged to a record. And Diageo shares rise after the world's largest distiller said consumers remain resilient and that it's able to pass along price increases to consumers. More with that interview from Diageo CEO ahead.
We have been able to pass along the price increases that we needed to. But, look, we are being very surgical about it. We're seeing inflation kind of moderate as we go forward.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Central Bank Palooza continues this week. Of course, we have the Bank of England later on. But overnight, getting some news out of Australia. They're pausing their rates for a second time in a row, really saying, look, perhaps the inflationary story is over for them. What's important to keep in mind, though, is you look at what economists and strategists are saying. It's simply that, well, maybe Australia actually won the fight on inflation. Another take, perhaps, they're so exposed to the Chinese growth story that as you see the Chinese data come in worse and worse, as we did, of course, overnight as well, that having a real read-through into the Australian economy as well. The question is, though, is if you start to see some of these rates kind of come down a little bit more and more, real rates are still in negative territory. Why pause now? And that's the question I'm going to put to a true expert. Bloomberg's Valerie Teitel joins us now. Valerie, your thoughts?
Look, Kriti, it's all about their forecast horizon from the RBA, a very subtle change from the RBA in that statement. They now declare inflation moving back to target within their forecast horizon. And that in central bank speak is the closest thing you're going to hear to mission accomplished from the RBA. They did still keep that threat of additional hike on the table. They still want to communicate they're in a hiking bias. But the fact that they are now seeing inflation falling back to 2 to 3% within their forecast horizon is great news for the RBA. And markets are jumping to conclusions here and think that the hiking cycle may be over.
It's not just for the RBA, though. To what degree do we look at this and say, globally, the hiking cycle, it's hit its end?
Look, Dani, it's all because we've gotten such good news on inflation recently. The RBA especially, they had the monthly CPI print last week, came in weak. And then 2 weeks ago, we got that real soft U.S. Data print. It's all about the trajectory of inflation for here. And if we keep seeing forecasts of inflation move further down, there's really no reason to keep hiking if you have that in mind, if you have that growth slowdown, that impulse then onto inflation slowing already in mind. So maybe it's too early for them to explicitly say mission accomplished, but the markets are sure trading that narrative.
What about today's data? JOLTS and ISM out of the U.S. Is that going to add? Do we care about them? Could it change this narrative?
I'm going to be very interested in the ISM manufacturing data, and that's specifically because in the PMIs last week, manufacturing came in better than expected, right? I want to know if that's confirmed in the ISM surveys today, because again, that points to the fact that this U.S. economy, manufacturing, which was one kind of dim light in the U.S. economy, is seeing a rebound. A lot of that goes back to the enormous government spending we've seen from the various tax packages that the Biden administration has gone through. Do we see a bigger rebound in manufacturing going into Q3 and into Q4? And perhaps does that maybe delay this recession that we keep talking about? And I know that economists keep scrapping their views on.
Valerie, walk us through the market read through here when it comes to the dollar specifically. So many cross currents here. Overnight, one of the biggest movers of the dollar has been the Australian dollar, on the other hand. So interest rate differentials perhaps playing a role, but then you have data like the kind you just pointed out. What is driving the dollar right now?
Interest rate differentials were a big one overnight with the market repricing the trajectory of the RBA slightly. We're seeing that weakening in the Aussie. But look, the other one that's really driving markets at the moment is just this weakening we're seeing in yen. Yen is a very, very liquid pair when it comes to those popular dollar crosses we're seeing. And this weakening that we're seeing, it's now extending for 2 days in a row, maybe 3 days in a row after that Friday's shock yield curve control announcement, is the fact that the market is telling the BOJ, look, I don't think you've done enough on inflation. And because you're so hesitant to talk about this hiking cycle, you're really risking a weakening currency move. And I don't want to jump to too many conclusions, but Kriti, we're really not far away from the last time the MOF intervened in dollar yen. Remember, that was at a 144, 145 handle. We're just hovering shy of 143. So if this market narrative keeps pushing the BOJ to say, we want more, we want some more tightening, if they don't respond, you will see more weakening in the yen currency. And
we're not just at risk of that with Japanese data, are we? It's also the U.S. data. I mean, it's today's data, right? That could really challenge the BOJ if there's any move higher in yields globally.
Yeah, exactly. For instance, if we see a big, strong a rebound in that ISM manufacturing print, if JOLT still shows a very tight labor market, and let's say we get a 10 basis point rise in those 10-year treasuries, what happens tomorrow morning when those JGB yields want to respond to global yields moving higher? Does the BOJ step in again? What kind of firepower are they going to have? And again, what is their tolerance for daily volatility? Because look, if you think about this scenario from here, it gets real bad for the Bank of Japan if the U.S. economy stays strong and if the Fed really does have to hold rates higher for longer. That is going to put a lot of pressure on this yield curve control tweak, a lot of pressure on more eyebrows being raised. Why aren't you raising rates, Japan? And maybe we'll see them being tested by the markets even more.
Yeah, last time they were happy to buy at 60 basis points. Maybe 70 is next. Maybe they keep going all the way up to 1%. Valerie, thank you so much for joining. As always, that's Bloomberg's Valerie Teitel. And for more market analysis, MLive Go is where you want to head on your terminal. This is Bloomberg.
It's funny, when people talk about this environment, it makes me think of the sort of old Looney Tunes cartoon where the character is sort of running above the air, and you're not quite sure if they'll sort of crash or if some sort of parachutes will appear and help them float. And the key word is uncertainty. This is what we hear, we hear with our clients. They're not sure how markets will react, and what we provide is firmly to address this uncertainty.
Man Group CFO Antoine Forte there speaking on Bloomberg earlier. Kriti, you kind of got a feel for being a publicly listed hedge fund because they had a record AUM. They had inflows when there was doubts that they could get them, considering the hedge fund industry has been struggling as a whole. Yet shares are selling off this morning because the fees have been lower because the performance hasn't been as good. I also asked Antoine about that, and he basically just brushed it off, saying analysts just want to put a number inside of an Excel spreadsheet box. He literally said that. I'm not putting words in his mouth, and just saying, we don't care about the day-to-day movement.
Well, it's interesting the way that he's kind of talking about this, because essentially a lot of that is tied to their business model. And to some extent, that is true. But then there's also this kind of macro theme as well. If you look at a lot of the banks that do have kind of these funds that operate underneath them, I'm thinking Morgan Stanley, for example, it's a similar dynamic, especially as you start to see, especially in the equity market, those incremental gains get smaller and smaller. You're not going to be making as much commission on those. So perhaps there's a macro read through as well.
The good news, though, is that they're not losing investors. And that's really what Antoine there hung his hat up on. Now, a lot of earnings today, Kriti, and I also caught up with the new CEO of Diageo, Deborah Crew, and she started out by speaking to us about the U.S. market.
The American consumer has been pretty resilient. Our industry is very resilient. We're seeing growth for the industry back in the mid-single digits. Which that's really where it was pre-COVID and pre this kind of COVID super cycle. We are still seeing premiumization within the consumer. Prices, so what's driving the growth is really the super premium priced products. So things that are like $30 plus.
Now, Kriti, I also pressed her on pricing, whether they could continue to hike prices. She said that inflation is starting to come down. So I said, okay, do you need to keep hiking prices and will consumers keep paying for it? She said, one, yes, consumers will keep paying up. And two, they're not going to rule out further price increases, which suggests that they likely will. I think this is interesting as we're trying to get a read on the American consumer. For those that drink premium brand whiskeys and alcohol in general, clearly there's resilience and they're willing to pay for it.
They are willing to pay for it unless the bottles are about more than $100, in which case you aren't seeing as much growth for that company as before. I think she mentioned that in the interview as well. Dani, I think what's interesting, though, is that a lot of companies, not just Diageo, are actually really testing the elasticity of the consumer. I wonder what happens when they hit that point that the consumer says, you know what, we're not going to pay this anymore. It's too much. And it's been, I'm going to say, at least a year and a half where we were expecting that to be on the horizon, and we still haven't hit that point. I wonder what happens to a lot of these corporate profits, a lot of the green on the screen we're seeing when we do.
You know what's sad? Their tequila couldn't keep up with the record growth they had. What are you drinking, Kriti? What's your drink of choice? Is it tequila?
At the moment, it's gin, but I have an issue in that there's so many different kinds of gin at the bar. When they ask you what kind of gin do you want, I don't have an answer. So I think I need like a proper gin tasting. Maybe you can set that up for me.
I see. We'll get you set up. We'll get some Tanqueray in there, some Bombay Sapphire. Hendrix, though, Kriti, is what you should be drinking, obviously. We'll give you a tasting when you're in London. All right, coming up, we're going to get back to the markets and speak to Jay Woods, Chief Global Strategist at Freedom Capital Markets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Markets kicking off August on a cautious note. Investors assessing more lackluster data from China while the RBA keeps the door open to future rate hikes. Plus mixed earnings news. We've got the roundup of the latest results from big oil to autos and, of course, the world's largest distiller. There's still even more blockbuster earnings to come before the week is out. And UK house prices are falling at the fastest pace since 2009. Details on that data amid the Bank of England's fight against inflation. I'm Kriti Gupta in New York with Dani Berger in London. Dani, it feels like earnings are really going to be driving the market, essentially a sum of all parts trade. But right now, not such great data coming out of Europe or China.
No, not great data. We had manufacturing PMIs coming out of a variety of regions, all of those still in contractions. Their earnings aren't great either, Kriti. They're uneven, but on a headline basis, at least as of the end of last week, we were looking at a majority of misses. When it comes to the European index, we're down about 0.5%. Some bad news from BMW on an expensive supply chain they're grappling with really seemed to drag this index further down because it brought the entirety of the auto sector down with it. China certainly not helping either. Basic resources, basic materials, those are moving lower in terms of that sector. Meanwhile, euro versus dollar, sterling versus dollar, all of them are fighting the strong greenback headwind as we prepare for a whole host of U.S. data we're going to be getting today. So maybe some of the bad data playing into euro weakness below 110. Sterling not doing as poorly. Two pieces of data we got today. Housing prices falling, but at the same time, shop prices are falling. That's good news for the consumer, a little bit of easing in inflation. So perhaps that's why we're seeing sterling not doing as badly in terms of performance against the dollar, Kriti.
Yeah, and that's going to be some sentiment that perhaps feeds the dollar as well. Dani, I want to get a quick check on what the U.S. side is doing as well, because you mentioned that cautious sentiment that you were seeing in European stocks. We're seeing a lot of that in futures as well here. Stateside, 4,600 right on the dot for those contracts, down about 0.3%. Those round numbers, they really matter, especially for the bond market, really kind of hitting that 4% level on the 10-year yield. 396 at the moment. Well, we are getting close. Again, the technicals playing in there. The dollar gets interesting, Dani. You mentioned the cable rate. I'm going to bring it back to the Aussie because, of course, we heard from the RBA overnight. They are pausing their interest rate hikes for a second time in a row. That weighing on the currency and giving, I think, a pretty big boost to the greenback this morning. Also getting a little bit of boost from China as well. That weaker data not playing in well to the offshore yuan. Dollar yuan, 717 there, stronger by about 0.4%. I want to come back to the equity markets, though, because overnight, a big call from a new bull on Wall Street. Oppenheimer coming out and raising their record year-end forecast for the S&P 500 to get this, 4,900. That's about 300 basis points higher. They write, quote, our price target assumes that the resilience exhibited by the U.S. economy will continue along with a high level of sensitivity by the Federal Reserve in raising its benchmark rates further. Essentially, stocks higher because rates lower. And that's actually a sentiment that David Kostin over at Goldman Sachs shared as well. Let's bring in an expert, someone who has a ton of experience in the stock market. Jay Woods, Chief Global Strategist at Freedom Capital Markets, joins me right here on set. All right, when we talk about upside in this market, everyone has seemed to turn the tide a little bit, and yet we're going into 2 months that are seasonally known as a little choppy for the equity market. What side of this do you stand on?
Well, I welcome the new bulls to the party. It's been going on for a little while, so it's nice to see those. Yes, seasonal headwinds are a major factor. August, September, the last 20 years have been, they've been exciting. I know last time I was on, Dani complained the market wasn't exciting, and I called for a boring uptrend. I think we should, no 1% drawdowns in 2 months. So yeah, that's boring. But bull markets tend to be that way. And any of these new calls I think are smart. The next 2 months could be choppy. We draw back down 5% in the S&P 500. That happens on average about 3 times a year. That brings us to the 50-day rising moving average. So as a technician, that's a healthy pullback. And then we go into the last quarter, which seasonally and in an election year or pre-election year, it tends to be one of the strongest. So I think the momentum continues into year end, and I think that's a great call.
Yeah, a lot of tailwinds for the S&P 500. But let's talk about breadth here, because that's been the issue when we first started seeing a little bit of the positivity. For me, when I look at breadth, I look at, does the Russell and the NASDAQ, are they both moving in the same direction? If they are, I mean, there's momentum to this breadth. Talk to us a little bit about the Russell, though, because it hasn't really recovered back to where it used to be.
Well, they finally are all moving in the same direction. The NASDAQ, some of the leaders are pausing a little bit, and that's healthy. And what we've talked about many times is rotation. And now we're seeing it in the Russell 2000, the small cap index. People are chasing performance. People are looking where you can find some, nice upside. If you look at the drawdown from the peak in the Russell, we can still go up 19% before we hit 50 all-time highs. So this 2000 level, yes, it sounds psychologically nice. You probably get a nice hat if you're at the floor of the New York Stock Exchange to celebrate. But no, this is just a breakout, and we should see continued momentum. It has a nice long base, consistent higher lows, and now we're seeing momentum into it. So this, to me, is just more continuation of a revolving bull market.
I used to have a Dow 20,000 hat at one point, and I gave it away as a gift to my stock market editor in the U.S., and I still regret it to this day, Jay. If you ever come across one, hand it to me. I'll look like an Uber bear if I wear it, so that's a cool thing. Jay, when it comes to energy stocks, the energy ETF, XLE, it's up about 7.5% on the month. For the entirety of the year, a little bit less than that. But it is crude's best month since January 2022. Does that trend continue? Does the market, in terms of stocks, also need to play catch-up?
Yeah, this is one sector. The XLE, the energy sector, was the leading sector 2 years in a row, and it was lagging, and you got the rotation into tech. It was a sector, to me, that looked very toppy, but we're seeing resilience in the XLE when 39% of that index is 2 stocks, Chevron and ExxonMobil, and they're just starting to make moves. Chevron got a great upgrade yesterday, I believe it was from Goldman Sachs, and ExxonMobil has been starting to run. They're both heading towards that 200-day moving average. They're both in a nice little consolidating zone, but they can't break down. They never did. And then watch crude. Crude at 83.5. If we can get there and break above it, you should see a run to 85.90, and it could happen quickly. So there's some action for you. And this is a sector that, people may chase into because it's underperformed the rest of the market.
Jay, the most read story on the terminal this morning is data from the prime brokerage services of both Goldman Sachs and JP Morgan that hedge funds have degrossed. They've taken profits both on the long and losses on the short end and just gotten closer down to the ground. When you look at something like that, is that a good thing? Does that mean there's more firepower to keep this market going? Or if hedge funds are turning cautious, do you want to turn cautious too?
Well, maybe they're turning cautious because of those seasonal headwinds, but no, I think it's a good thing. I think people are ready to, one, they have to play catch up. If you weren't in some of those top 7 stocks in the first half of the year. Now you got to find, where can I get that kind of performance? The stocks that can rebound, the stocks that have been beaten down the most, are starting to lift their heads. There are so many nice long bases that, as a technician, you want to see start to turn, and you can get quick gains like you saw on a Roku or a Coinbase, or most of the stocks in the ARK fund for that matter. So when you hear that there's some readjusting, I think they're positioning themselves. They're getting ready to chase a little bit, and it should make for a strong end of the year.
All right, Jay, poke holes in your own theory for us. Where are the risks that you think that could undermine all of this positivity, completely turn the tide and reverse, I think, the almost 30% gains we're seeing?
Yeah, well, the Fed is always a risk, but then when Neil Kashkari comes out, one of the most hawkish Fed governors, and says that the soft landing is approaching, it kind of took me by surprise. When everyone gets on this bullish kick, then I'm going to be a little concerned. When sentiment goes through the roof, I'll be a little concerned. Economically wise, things have been going okay. I'm trying to poke holes in it all the time, but we're still seeing that slow, steady rotation that you want to see. Jackson Hole's coming up. I believe it's August 25th, 26th. Last year, if you recall, that was not a very good time for the market. That was our top. I don't think Powell's going to put a little cold water on our recent rally this time like he did last time. Yeah. But that's something I watch. And then September, historically, people think October because of the big crashes. And I've heard, the Dow was up 13 days in a row in 1987, just like we were now. So maybe that's a sign of things to come. But outside of a black swan event, a Taiwan event, that we really don't like to predict, or we're not in the game of predicting. Yeah. I'm going to continue to follow the trend, and I'll let you know when there are holes to poke. But right now, it's slow and steady again, but I still think, Dani, we see some action in the coming months.
Yeah, we'll definitely bring you back to do that. Talk to us a little bit about the earnings picture as well. Dani and I have been covering the earnings story all morning. Yeah. And one of the consistencies you're seeing on both sides of the Atlantic is simply this idea that price hikes are still digestible by consumers around the world. But at some point, that's going to stop. Do you then see a massive wave of, I want to say, kind of punishing some of these corporate companies who have been able to push those price hikes through?
Well, you're talking about some of the discretionary. You want to talk earnings. Let's talk about Starbucks, to me, an international brand. I was just in London, and, it's a little more expensive over there. They're a little slower there, too, when they, serve you. But their earnings are out after the bell today. And technically, you have what some may say looks like a head and shoulders top. It's a little ugly, but it's at an inflection point. It's at the 200-day moving average. And you talk about headwinds. You have student debt coming back. And now I kind of have my pulse on those college students having that. I have 3 of them. And, where are they going to cut back? Maybe they're going to finally realize that Starbucks is, something that we have to pull back on. And then with Starbucks, you always have to watch their numbers out of China. And then coffee, it's starting to bottom and tick up. So will they be able to absorb that, pass it on to the consumer? I think the consumer may pull back when the student debt payments start at the end of September, beginning of October.
Yeah, and reporting those earnings after the bell, Jay Woods, we thank you as always. Of course, here at Starbucks, Jay wants better service in London. He joins us as always.
We like to pretend we're Italian here, Kriti. We like to pretend we're Italian, slow service, that kind of vibe.
Don't let Francine Lacqua hear you say that. Like, she's coming for you.
No, she'd be mad at me.
Coming up on the show, we're going to get a check on autos as BMW warns that higher supply chain costs will weigh on cash flow this year. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an exclusive interview with Paul Taubman, PJT Partners Chairman and CEO. Coming up at 10:45 New York, 3:45 in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Shares of BMW are falling this morning after warning of higher costs for developing EVs and stocking up on parts in a difficult supply chain environment. Joining us now is Bloomberg's Oliver Crook. Clearly, the market doesn't like this one, Oliver. BMW sold off really steadily after the announcement. What exactly is giving them such a headache?
Yeah, I mean, the numbers themselves were basically in line with estimates. And in fact, they felt comfortable enough to raise their forecast. And also, they did better on margins and they raised their forecast for margins. However, investors are looking a little further into the future. As you say, they're concerned about some of the comments they made about how much it's going to cost to develop the EVs for BMW. They're saying it's going to cost more, that there might be some supply chain issues again in the back half of the year. You know, VW flagged some logistics issues. They had to reduce the number of car deliveries that they're going to have this year as a result of that. Porsche saying that they weren't going to be able to get all of the parts for their EVs. So really this is, you know, and Stellantis even worrying about the chip supply. So we're down, what, about 6-7% this morning on BMW, still up about 25% this year. What they didn't update on the pre-release, however, Dani, was how many cars that they had on that ship that was burning off of the Netherlands. That is what I'm watching for. You know, they said maybe a couple hundred, but that could be in the thousands. It could be, you know, 200.
Ollie, you've been talking a lot about the German car makers. Let's go internationally here. How does it compare to the earnings we got out of Toyota, for example?
Yes, so Toyota, we don't talk really nearly enough about. It's still the biggest car maker in the world, really pulled ahead of Volkswagen in terms of number of deliveries. They beat on profit. They've done they had the best month of June in terms of manufacturing and sales on record. They are saying that their semiconductor supply situation is looking good, and the weaker yen helped them critically. You know, 76% of their sales are done overseas, so that has been a big part. They're being conservative, however, they're not raising their outlook or anything like that. Their shares rose to a record over in Japan today, and really echoing some of the positivity we've had out of the auto sector here in Europe.
Elsewhere in the auto sector, specifically with EVs, people familiar telling Bloomberg that Exxon is in talks with Tesla, Ford, VW on supplying lithium. This is an interesting development, Oliver. I mean, is it just Exxon tying their fortune to what is a strong EV market?
I would say so. I mean, listen, this is the holy grail. This is lithium here. This is what is going to fund and, you know, power. Yeah, this is pretty exciting. This is spodumene. This is not the kind that they're going to be extracting. Exxon is looking to extract brine, so salt underground water, lithium from underground and take it out. They say they've got synergies with their drilling business, even their refining business, and so potentially they could benefit from that. If you look at the price of lithium, you know, it rallied about 1,100% from 2021 to the peak, now up about 400%. And you can understand why Exxon wants a piece of the action. So what we know from people familiar, they're in talks with, as you say, Tesla, Volkswagen, and Ford. They're setting a goal of 100,000 tons of lithium a year, and they've already picked up some acreage over in Arkansas where they're starting to apparently begin to explore this. So still early days, but they want a piece of the action.
Bloomberg's Oliver Crook covering all the automakers and having his Bill Nye moment on Bloomberg Television as well. We thank you as always. Coming up, we stick with the earnings story. Caterpillar earnings out in less than an hour. We're going to get a closer look next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Let's get you set up for your day and take a look at what's ahead. 9:45 a.m. Eastern, we're going to get U.S. manufacturing PMI. It's been strong thanks to the Inflation Reduction Act. Will that continue? It will be followed by JOLT job data. That will be at 10 a.m. Eastern time. Plus, we're also going to hear from the Chicago Fed President Austin Goolsbee. And among the many companies reporting, Kriti, we're going to get Uber, Merck, Pfizer, Marriott, Starbucks, and Caterpillar, one we have our eye on, reporting within the next hour.
Well, let's start there, Dani, because, of course, we know of Caterpillar as kind of this global bellwether that a lot of people look at. Demand for their iconic excavators also going to be in focus for investors. Let's bring in a true expert. Bloomberg Intelligence industrials analyst Christopher Cellino joins us on Bloomberg Television this morning. Thank you for waking up bright and early for us. I'm sure it wasn't for the earnings, definitely for us. But walk us through kind of this idea of it being a global bellwether. We had DHL, for example, report in the European session as well. They're talking about not beating to the extent that the market thought that they would. When you're talking about CAT in terms of the kind of global economy, what are you looking for? What's your kind of canary in the coal mine there?
Yeah, so CAT, obviously the largest construction equipment manufacturer, touches a lot of different end markets and regions globally. So I mean, we expect CAT to put up another real solid quarter, maybe not as strong as 1Q, but still anticipate very strong operating performance as really customer demand across most of its end markets remains generally healthy. We'd expect pretty sizable year-over-year margin improvement across all of its core businesses on what is still a really favorable pricing environment, healthy volume growth, and improved manufacturing efficiencies as the supply chain continues to normalize here.
What about demand in Asia and in particular China, Chris? How big of a drag might that be when they report?
China's going to be weak, and we saw it take another kind of leg down here in the quarter. If you think about China, historically, it's been about 5 to 10% of consolidated revenue at Caterpillar, but just given some of the weakness in the market over the past few years, it's even going to be below 5% of total sales this year. I would anticipate that they'll be pretty cautious on China and the outlook for the rest of this year, but would anticipate some sort of rebound starting to materialize into 2024.
Chris, talk to us a little bit about the backlog here, the order flow. What is Caterpillar seeing in terms of whether they can actually meet the capacity that they're perhaps being dealt with?
Yeah, so I think this is actually going to be the bigger question, and really the focus when they report earnings is really going to be the sustainability of this level of performance, as we kind of appear to be approaching a peak in the cycle. So orders inflected for the first time in 2+ years last quarter. Backlog has probably peaked, and dealers are expected to reduce inventory levels over the balance of the year. So there's a number of signs that would seem to suggest a coming slowdown. So that's certainly going to be in focus when they report this morning.
Is this a normal cycle, though, Chris, when you've had this huge boost to construction thanks to the Inflation Reduction Act?
No, not a normal cycle by any stretch. As you mentioned, we have an immense amount of fiscal stimulus coming through the pipe here. So I think, that you're probably looking at a more resilient CAT through this next downturn because of the immense amount of fiscal spending. We're really not seeing signs of customers in financial distress. So, they're in a financially healthier position compared to prior slowdowns. And the services business has grown quite a bit. That's a larger portion of the overall business and very profitable. So that tends to be a little bit more durable in downturns. So I think Caterpillar will certainly hold up better and post probably better decrementals than what we've seen in prior cycles.
Well, let's see if the stock reflects that. At the moment, we're seeing Caterpillar shares down about 0.4%. Christopher Cellino of Bloomberg Intelligence all over that story for us. Of course, we do expect those earnings coming at about 6:30 a.m. New York time. Let's take a look at some of the other stocks we're watching in pre-market trading. Tesla at the top of that docket, potentially cutting prices on some of their Model 3, Model Y vehicles in Hong Kong. That coming from Reuters, citing the Hong Kong Economic Times. And remember, it's not China, because Tesla had signed on to that price kind of packed with a lot of the EV makers there. This is specifically for Hong Kong, pulling those shares down by 0.8%. A big part of the tech story has also been jobs, simply, which brings us to Alphabet shares, those down by about 0.6%. Reports that they're going to eliminate some jobs in the assistant overhaul coming from Axios as well. In a similar vein, CVS also looking to cut about 5,000 jobs in their cost reduction push, according to the Wall Street Journal. Those shares higher by about 1.5%. So some interesting mixed pictures about whether or not that's viewed as a positive thing, Dani. And of course, earnings season continues. Stateside, we've got Merck, Pfizer, Uber, and Norwegian Cruise Lines. And those are just some of the names for the opening bell. You are seeing a lot of green on screen for all four companies, Dani.
Fortunes are certainly different for Europe, Kriti. As we've been speaking, we're looking at European big cap stocks. The Europe Stocks 50 plumbed the lows of the session. It's down more than 1%. That's the top of the board there. What is moving that is LVMH, perhaps some China weakness, and BMW. We're just talking to our reporter Oliver on that, concerns about the supply chain. But those are the big weights on here, pulling everything down. Aussie dollar also at the weakest of the session after the RBA, Kriti, decided to hold rates, saying, hey, more hikes might be coming. But we're clearly getting a big positioning shift as traders bet this is it. This is the end of rate hikes, at least for the RBA.
Yeah, and that sentiment really seeping into U.S. as well. That does it for Early Edition. Surveillance is ahead. Tom, John, Lisa, take it from here. This is Bloomberg.